Investor psychology, the hidden key to wealth creation. Most people think investing is about choosing the right stocks. But the biggest factor behind investment success is not intelligence, education, or stock tips. It is psychology. The stock market is not just a market of stocks, it is a market of human emotions. Fear, greed, patience, overconfidence, and discipline often decide whether investors become wealthy or lose money. Today, we'll understand investors' psychology with simple Indian examples and learn how successful investors think differently. First, fear and greed drive markets. The two strongest emotions in investing are fear and greed. When markets are rising rapidly, people become greedy. When markets are falling, people become fearful. Example, COVID crash 2020. During March 2020, the Nifty fell nearly 40%. Many investors sold their holding because they feared the market would keep falling. But investors who stayed invested or bought quality companies like HDFC Bank, Reliance, TCS saw tremendous gains over the next few years. Fear caused many investors to sell at the worst possible time. Second, herd mentality. Humans naturally follow crowd. If everyone is buying, we want to buy. If everyone is selling, we want to sell. This is called herd mentality. Example, IPO mania. When companies like Paytm and Zomato launched IPOs, many investors subscribed simply because everyone else was talking about them. Few analyzed the valuation. Many investors bought due to excitement rather than business fundamentals. Following the crowd can be dangerous. Fear of missing out, FOMO. FOMO is one of the biggest wealth destroyers. Investors see others making money and rush in. Example, stock rises from 100 to 500 rupees. People ignore it initially. After hearing success stories elsewhere, they buy at 500. Soon the stock falls to 300. The problem wasn't the company, the problem was buying due to FOMO. Successful investors buy based on value, not excitement. FOMO occurs when investors buy a stock mainly because its price is rising and everyone seems to be making money from it. Example, Adani Green Energy. Massive rally attracted investor chase momentum. Adani Total Gas. Rapid price appreciation led many to buy late. Tata Elxsi. Multi-bagger return attracted new investors. Zomato. Sharp rally after profitability improvements. Paytm. Initial IPO excitement and market buzz. Nykaa. Popular consumer brand and IPO enthusiasm. BSE. Strong rally during increased retail participation. Buying because everyone is talking about the stock. Investing without understanding the business. Ignoring valuation concerns. Feeling urgency to buy immediately. Increasing investment amounts after seeing others profit. Warren Buffett's reminder, be fearful when others are greedy and greedy when others are fearful. The biggest gains often come from patience, not from chasing the hottest stock. Loss aversion. Studies show people feel the pain of losses much more than the joy of gain. Losing 10,000 hurts more than gaining 10,000 feels good. You buy a stock at 1000 rupees, it falls to 700 rupees. Instead of accepting the mistake, you keep holding forever because selling would make the loss real. Many investors keep weak stock for years while selling winners too early. Overconfidence. After a few successful investments, investors often believe they are experts. This leads to larger risk. During the 2021 bull market, many new investors made profit. Some believed every stock they picked would rise. They borrowed money and concentrated heavily in risky stocks. When the market corrected, many suffered heavy losses. The market has a way of humbling overconfident investors. Recency bias. People assume recent event will continue forever. When IT stocks perform well for 2 years, investors believe they will outperform always. When small cap stocks rise rapidly, investors think they can never fall. History shows every sector goes through cycles. Smart investors think long term. Anchoring bias. People become attached to a specific number. You buy a stock at 1500, it falls to 1000 rupees. You refuse to sell until it reaches 1500 again. But the market doesn't care about your purchase price. Investment decisions should depend on future prospects, not past prices. Patience, the investor's superpower. Most wealth is created through patience. Many Indians who regularly invested in Nifty index fund for 10 to 15 years created substantial wealth. They didn't predict markets, they simply stayed invested. Patience often beats intelligence in investing. Thinking like Warren Buffett. Warren Buffett often says, be fearful when others are greedy, and greedy when others are fearful. This means buy when quality companies are unpopular. Avoid chasing hype. Focus on business quality. Think long term. This psychological discipline made Buffett one of the greatest investors in the world. How successful Indian investors think. Investors such as Rakesh Jhunjhunwala, Radhakrishan Damani focused on patience. They held winners for years. Conviction, they trusted their research. Discipline, they ignored market noise. Long term thinking, they focused on business growth rather than daily stock prices. Rules to master investor psychology. Rule 1, never invest based on social media hype. Rule 2, don't panic during market crashes. Rule 3, avoid checking stocks prices every hour. Rule 4, focus on business quality, not stock tips. Rule 5, think in years, not days. The biggest battle in investing is not against the market, it is against your own emotions. Fear causes investors to sell. Greed causes investors to chase. Overconfidence causes investors to take unnecessary risk. The investors who build wealth are usually not the smartest, they are the most disciplined. Master your emotions, stay patient, invest consistently, and let compounding work for you. Because in investing, psychology often matters more than stock selection.